Welcome to the daily update, where I'll go over the action in the market for Thursday, October 24th. Then we'll see how things look for Friday, October 25th. Had an up day, and we're still holding with the 20 period moving averages, but we are seeing some internal weakness. Now, a good solid up day could take care of that, but a good solid down day could diminish what we're seeing. So we're kind of watching the 20 period moving averages. It's been, or those have been tested twice now. The reason I say those, there's a simple and an exponential moving average, and they're really close to each other. We came down below it in Wednesday's session, but we're able to cross back and close above it. We came right down to it on Thursday, and that was the low that was set for Thursday's session. So we've tested it twice now. So we could launch up from here and actually turn more positive. But we're seeing some other things inside the market that are giving us some concerns. There's other things that are giving us some confidence. So we're getting kind of a mixed picture right now. I have a thing called the SPXInvesting Program. It's free until the end of 2024. There are additional videos plus early access to the videos that I post on YouTube and Rumble that as a member, you get access to that. And there are courses that I have, and I have one course up there now. I'll be rolling out more once things get locked down, but feel free to check that out. And if you have any questions, here's an email address. So just see if it's something that may be helpful to you. Also, the daily video is the real foundation of the analysis that I do. We're coming up to the end of the week. Over the weekend, I'll be doing all of the outside videos that you see here, but they all tie into the daily video. All right, let's go back and talk about what happened and then look at some charts. We did have a higher open, and Europe had a pretty good day, and that helped promote higher prices for the S&P 500 futures, and we were looking up about 0.5%. We gave that up right away, but it was a higher open. We got above the daily pivot because we had closed closed below 5,800 after Wednesday. We opened above 5,800 in Thursday's session. The daily pivot was at 57.98, and then we just chopped around. There was not a lot of conviction that happened. We ended up chopping down below the daily pivot. We did find support at the 20 period moving averages, and then we climbed back above the daily pivot to close near the opening price of 5,800. So the market's just kind of figuring out to see, all right, are we going to break to the upside? Are we going to break to the downside? You can make a case for either side right now. We were up 0.21% on below average volume. That seems to be pretty consistent these days. We are still positive in the short, intermediate, and long term because we're above the moving averages. That's how that is measured. And what helped stocks in Thursday's session is that the 10-year yield and all interest rates, which had really been going up, they finally started to come down. The dollar, which has been going up, it started to come down. And so this gave some support to stocks. We also had just a slew of earnings reports, which helped different areas of the market as well. But then other earnings reports came out, and that's why the Dow ended up closing lower. So we're seeing a real mixed picture. We want to keep an eye on the geopolitical things going on. And I've added this one, the US election. We're less than 2 weeks away from that. And we'll just have to see, is that going to have any impact on the market? Now, typically, the stock market doesn't really, it doesn't care. It doesn't care if it's Republican, Democrat, because they have friends on both sides. There's a lot of good old boys type things going on there. What they're more concerned about is what's going to happen with Congress. Are they going to be split between Republican and Democrat, or is it going to be all Republican, all Democrat? That's when they get concerned, when one party has the majority in the two main branches of the government, because that means they come in and they pass rules and regulations. And usually that means you can't do this, you can't do that. It's going to cost more for this, cost more for that. And so they like it when there's more gridlock in the stock market because they see what happens in Washington, D.C. as theater. It's not real. And my goodness, you watch what's going on on both sides right now. And yeah, it's theater, but people get pretty worked up over this stuff. So we want to keep that in the back of our mind too. Okay, some comments. We did get above 5,800 for the S&P, and for right now, the 20 period moving averages are providing support, and I'll show you charts of that. Tesla, my goodness, came out with their earnings and just skyrocketed up. Ended up closing up almost 22% after their earnings report came out. Massive gain there. That really helped the discretionary sector. And then Amazon had an up day. So we're seeing an improvement in that area, which is kind of like a growth area. So we want discretionary to do better if we're more positive on the market. And then Boeing pressured the Dow. Now, they're supposed to come out with earnings. I don't know if they've already done that or not. I don't follow these stocks all that close, but they voted down this strike. They came back with a proposal, and the employees said, nope, we're not going to take that. That pressured Boeing stock. Honeywell and IBM came out with their earnings, and they were not well received. So all of this together did put pressure on the Dow. Interest rates in the US dollar, the declines that we've been seeing, especially in Thursday's session, this helped give support to stocks. As they were going up, they were putting pressure on stocks. The VIX is still above 19. We're getting a pretty high reading there, but those VIX signals that I've been harping about for about a week and a half, seemed like forever. I was talking about them. They're gone now. Now, they could always come back, but for right now, those signals are not there. So maybe what happened in Wednesday's session is that seemed to be enough to make those signals go away. We want to keep an eye on the Middle East between Iran, Israel. Of course, then there's Hamas and Hezbollah and things going on in Lebanon and down in Yemen. It's just a lot of crazy things. But oil is still right around the $70 level. We're still looking extreme positive with the stochastics, even though this is a short-term indicator, and I break it down into different time frames based on the short term. Since the oscillator, the way it's designed, is it takes longer for this to actually move, even though it's short term. But we're already still extreme negative with the Stoch RSI. That's a really touchy indicator. In the intermediate term, not a very long list. We have the bullish percent index for the S&P. Now, we're a little concerned about that. It's extreme positive or overbought. That's what the OB is here. But we're coming down. So the context is coming down from a high reading. But we're still looking positive with the 10-day average of the S&P 500 new highs minus the new lows. Long term, we're still looking really solid with our 150 and 200 period moving averages. In fact, a little extreme, even though lately they've been coming down. We haven't really changed the scenario. Not enough economic reports, not enough things have been said to really change what we're going with right now. The concern that crept up recently is that maybe the economy is too strong. Like a week ago, Thursday, we had a whole slew of economic reports that were much stronger than expected, and the market's kind of waiting to see what's coming next. So far, we haven't seen a real continuation of this. Oh my gosh, the economy's too strong. The Fed's going to have to stop cutting rates. They may even have to come in and raise rates. That was pretty much confined to a week ago, Thursday. We're waiting to see if there's more confirmation that we just haven't really seen to this point. The dollar was down and interest rates were down, which, as I mentioned earlier, that did give support to stocks. We closed at 4.2% with the 10-year yield, where we had been at 4.24%. We're still inverted with the 10 to the 3-month yield curve, which now it's been well over 2 years. This is like the longest time in history that this particular yield curve, 10 to the 3-month, has been inverted, where we're uninverted or going back to normal with the 10 to the 2-year yield curve. Sentiment didn't change. We're still positive, but the context mostly has been that we're coming down. After last Friday, when we did really well with the S&P, we hit 75. Now 75, 76, 77. When we get above 75, that's where we're looking a little too extreme as far as sentiment. And so we've been coming down from that level. So the context is, yeah, we're positive, but we're declining from coming down from higher levels. We're still positive with our trend, not by very much. It did improve a little bit on Thursday, but the ADX is now weakening. It's dropped below its moving average, but we're still above 20, and I'll show you that chart. So we're in a trend, but it's a weakening trend. It's a positive trend, but it's a positive weakening trend. And the bias, and now this is the subjective area. This is what I come up with myself. I still say that we're mixed, even though we had an up day. When you look at the intraday chart, we just kind of were on a treadmill. We dipped lower and came back up, but we really didn't go anywhere all that much, although it was a positive close. The momentum, I'm still keeping it mixed to negative because we still had earlier days this week that were negative, but we're still hanging on above these, especially short-term moving averages. So that's why I'm keeping it more mixed to negative for right now. The economic reports that came out. This is probably one of the more important days. Now, Friday's going to have a couple of important reports too that I'll go through later. We did get weekly jobless claims, 227,000, a real drop. This is showing that the employment situation is holding up. They expected 246,000, and last week we had 242,000. So that's really coming down, and I'll show you a chart of this too. Continuing claims are still going up, though. We have 1.897. Last time it was 1.869. These are folks that are longer term unemployed. And then the US global US manufacturing PMI, I don't have charts of this one here. The takeaway is it above or below 50? When it's above 50, that shows expansion in manufacturing on a global scale. When it's below 50, that shows contraction, and that's what we're seeing. 47.8, last time it was 47.3. When we look at the services, we're still seeing growth there. 55.3 above that 50 level, where last time we saw 55.2. New home sales, more than expected. 738,000. They expected 713,000, up from the 709,000 that we saw last time there. So here's a chart of the new home sales going up and not real robust, but it is continuing to go up. What's been pressuring things lately is that interest rates have been going back up, and this has a direct impact on mortgages and refinancing. And so that's really slowed that part down. And then the median new home price on a year-over-year basis, and I have to move this bar right here so I can see all of this. Would they take a 3-month average where it had been coming down? Now it's starting to tick up just a little bit here. And then here are the jobless claims. Now, the moving average is still going up, but we saw a real drop off in the weekly number here. So one's going one way and the other one's going the other way. But the continuing claims are more in a trend. We're above the moving average, and the moving average is going up. That's a little bit of a concern if these continue to climb, but we'll just keep an eye on this to see if it becomes an even greater concern. And then here's the unemployment rate, which is coming down. We saw the initial claims drop where the continuing claims are going up, just to kind of give it a little bit of context here. Then Isabel Net blog charts. These are sales expectations against actual sales. Now, this is according to the NFIB. This is a small business here. Not looking really optimistic right now, and that could be a concern. So we'll have to see if there's some improvement here. But we've been kind of chopping more or less sideways for the last few years. Saw a decline here. We would like to see this actually get back above this red dashed line. That would be more positive. The S&P 500 and then earnings per share is denoted by Goldman Sachs here. They're seeing where things are going up from here. Now, the time this chart was created, we were at 5841. Right now, we're just under 5,800, or I should say a little bit over 5,800. They see us going up above 6,000, and then a year from now, we'll be at 6,300. Just talk about gambling. I mean, that's what forecasts do, but people love them. But I don't forecast myself. I just look at the charts. Now, what's justifying that is that the earnings per share projections going forward are also going up. And that's why you have stock prices go up, because they're driven by earnings. Then cyclically adjusted S&P price to earnings ratio. Now, I go over this pretty extensively in the weekend videos, like the intermarket analysis video. We're getting kind of high a little bit here, but we've been high for quite a while. And so personally, I don't use this as a timing mechanism. This is just more informational to say, yeah, okay, the PE ratio shows that stocks are expensive right now, but we could stay that way for years. Then 36% of S&P 500 constituents, and I actually took a screenshot of this. I use it in my class. and I was waiting for this to be updated. There are criteria in the S&P 500. That's one of the reasons I focus on the S&P 500. I went to a talk one time and somebody said, "Well, you can't really follow the indexes because they're taking the bad stocks out and putting the good stocks in." I'm like, "Wait a minute, you're trying to slam the S&P for doing that?" That just made it more valuable to me. And this was, 25 years ago or so that I heard this. And that's when, instead of just focusing on individual stocks, I started to focus just on the S&P. It's the most liquid. The options are available. You can do hedging. You can get in and you can get out quickly. Plus, there's some criteria built into the S&P so that it can be included and continued to be included in the S&P 500. So that just builds in some quality to the index itself. Well, this just shows that there's 30%, 36% of the constituents. These are stocks that make up the index. They turn over during a typical 10-year period. Even though the average is 36, so far we've been seeing about 31% of turnover. They get the bad ones out and put the good ones in. I kind of like that. I think that's good. That's okay. Anyway. And then the U.S. equity market technicals and financial conditions, we're looking at the cumulative advanced decline line. We do look at a version of this for the S&P 500. So this is just looking pretty solid right now. At the time this chart was taken, we go up and down and chop a little bit back and forth here, but this goes back longer term just to see that, yeah, we're looking pretty solid this way. And this is looking at GDP growth projections going out. And you see, notice over here on the right-hand side, emerging markets and developing economies. That's been kind of a buzz lately. Folks have been talking about it. They've been putting money into emerging markets. That's because you see higher growth here. They're supposed to be emerging. That means growing and developing. And so that's why a lot of investors will put their money into this area because they see growth projections looking pretty solid. We're globally, we're right around the 3.2% level. We were at 3.3 in 2023, and for 2024 and 2025, 3.2. So according to this, we're not necessarily going into a global recession because we would be negative with GDP if that were happening. And then advanced economies, that would be like Western Europe, the US, Japan, probably. They're seeing lower growth going forward from here. So that's what makes the emerging markets more enticing. All right, then I go over this in the intermarket analysis video, and I also saved this chart for that particular video. The copper to gold ratio, and then it's plotted here with the 10-year yield. You can see the purple line. This is a copper to gold ratio. And the 10-year yield, they tend to go more hand in hand with each other. But look at the massive disconnect that we're seeing right now. Because gold's been going up, copper's been doing okay. It's in an uptrend, and that's more of a barometer of the economy. But this just means down here, this just means with the purple line that copper's underperforming gold, as gold has been seeing some love lately. But then the 10-year yield up here, they're really far apart from each other. So what's going to happen here? If interest rates come down, is that going to help the purple line go up? Or is there going to be some combination of the two? So we'll just be keeping an eye on this. But this is a longer term chart. And then we have a thing called ERP, equity risk premium. And we look at it in the context of the US, where they're seeing the least amount of risk here at 2.8% in the US. The world here, that's at 4.2%. And then different countries, just what is the risk for getting into those particular stocks? And it's risk versus reward. If you take on more risk, then you're expecting more of a reward. But at the same time, that risk may actually come about. So it's seen as being less risky in the US. And then the risk appetite indicator, we're still above the zero level. So folks are still willing to put money into the market. Then this kind of spaghetti looking mess here, this is year-to-date performance of the S&P since 2000. These are all the other years down here, all squiggled around, and then where we're at in 2024 and near the very top end of the performance going back to 2000. I didn't see anything. I actually looked on Twitter, but didn't spend any time there. Okay, here's the intraday chart. So we had the big down day on Wednesday. What I was focusing on, both with this video and then the videos I post on the website, I was saying, okay, you see this nice little bounce back up near the end of Wednesday? Can that see a continuation on into Thursday session? No, didn't happen. But we were watching for it. And when it didn't happen, then I'm like, okay, this doesn't seem to have as much impact as we were thinking. We did have a higher open, but see how we just went sideways. We actually dropped down below the daily pivot. This low that we set right here was the 20 period moving averages. We bounced up off of that, came above the daily pivot, and then chopped sideways again. So this was more of a treadmill day taken all together. Intraday, we're we were looking pretty good here with the futures. They were up a bit in the initial overnight session, and then they started to really show some strength. This is about the time that Europe opened up, and it looked like, okay, maybe we're going to get a nice little bounce out of this. Well, didn't really work out that way. This is encouraging, though. We're seeing the blue line above the red line. This means that on an intraday basis, growth is outperforming value, and growth had a fairly good day on Thursday, and that's what we want if we're more positive on the S&P. So to see this going up, the blue line going up, and the red line just kind of it was negative on the day, and now that growth is outperforming, could be taken as positive. And we saw an improvement here with the growth to value ratio for the S&P. Now, around the beginning of October, we really liked this, and this is when the S&P was going up. And then we ran into some problems here and then started to go back up. And then we had Wednesday's session that just threw everything in the toilet. Well, in Thursday's session, we started to come back up again. So this is seeing some improvement. We're seeing some buy the dip that actually worked. Didn't work on Wednesday, but it seemed to do some good on Thursday. Now we'll see if there's any follow through Friday and then going forward. So we were up with growth where value was down. You can see quite a discrepancy between the two. Mid cap growth was up, but up less than value. But with the small caps, growth was up more than value. And I compare this column with this column. And then the middle area are the ETFs. Like this is SPY. I think this is MDY. Now, I usually look at IWM, but there's another ETF called SML, but that they got changed around recently. So I don't focus on that one as much as I used to. So not really seeing much of a change here with small cap growth to value. Still in a downtrend here. Not really improving all that much. Mid cap growth to value, a little bit of a tick up here, but still in a downtrend. This is a little more encouraging. We'd like to see more of this, of course. S&P growth to value. This is end of day where we did come up and we're still at the higher end of the range. It would be even more positive if we could break out of this recent range and really go higher. If this really breaks down, that would be more negative for the S&P. And the growth to value ETFs that we look at, we're still we bounced back up. We were more in the middle of the rainbow. Now we're getting a little bit higher to the top end of the rainbow, but not really breaking out of the rainbow and seeing the lines going back up, at least yet. Discretionary had a pretty good day here, mainly because of Tesla. So it bounced up here. When we look at discretionary by itself, staples, So we saw a little bit of an improvement here with the discretionary to staples ratio, which is what we want to see if we're more positive on the S&P. Large cap growth still doing quite well off of recent all-time highs. Our trend is weakening though. The black line is the ADX. That's the actual indicator. And then I put a moving average on here. We drop below that. The moving average is to give us some context to let us know, is it going up? Is it going down? Well, now this shows a weakening trend. Now, we're hanging on, not by very much, but the green line is still above the red line. If these cross, that would turn this over into a negative trend. We're seeing kind of that same thing here on the short-term chart. Below the moving average, green line getting close to the red line. Still below average with volume. And we ticked down just a little bit here with the VIX on the line chart, but we're still getting high readings overall, both with the line chart and the bar chart. The VIX of the VIX went up just a little bit. We're just a little bit above the moving averages here. This is the volatility of the VIX, but the momentum of the VIX continues to be down. So we've been coming down. The MACD is saying and that the momentum is down, and that's more positive for stocks. And historically, we're kind of getting some high readings right now, but that hasn't really taken much effect on stock prices, at least to this point. We ticked down with this one fear gauge where we ticked up with the other fear gauge. So we're seeing some contradiction there. We did get the latest reading from the American Association of Individual Investors, which, if you're listening to this video, that means you. Now, this is an actual organization that you can belong to, but people that just do this on their own, they are individual investors. And we came down in the latest reading, not feeling as positive about things right now. However, that's where you see the red arrow, and this is just a jumbled mess. That's why I put the arrow on here. I tried to highlight the latest number too, but the 50-day moving average is still continuing to go up. So we're still holding on to a longer term positive outlook there. Volatility risk premium tick back up. We're still getting a high reading here, kind of similar to what we're seeing with the VIX. So the market is still anticipating some risk going forward. And we came down with the daily chart of the equity put call ratio, but we really dropped with the 5-day chart. We're actually getting extreme now. Going down is positive, but when we drop below this, this is kind of like sentiment, meaning that maybe we've gone down too far, because usually when this is going up, that is more negative for stocks. And here's a long-term look at that chart. And you can just see when we had extreme readings above the red line or below the green line, and then what the S&P did after that. But the 10-day just kind of chopping around a little bit. It's still going up. So the 5 days going down, the 10 days going up, more of a contradiction there. That's why we're getting more of a mixed picture. Advanced decline line, still looking healthy, just kind of evened out based on price and evened out based on volume, but still above advancing moving averages. Saw a little bit more of a breakout of the new highs, but we're still pegged pretty much near the top right here. So it's having a hard time with our 5-day moving average really doing anything. Starting to turn back up slightly after coming down and flattening out now with the 10-day moving average. And we're just barely negative here with the 19-day advanced decline ratio. We dropped below zero, but the red line, 39 period advanced decline ratio, it's declining, but it's still above zero. The accumulation distribution, looking pretty good here. We ticked up just a little bit. We're still above an advancing moving average. This is a smart money indicator. And with this looking better, that is more confidence that the market is holding up. We also saw a tick up here with the Chaikin money flow, and I pointed this out yesterday. We're starting to turn back up. The histogram, which are the up and down column lines here, even with the down day, this still went up. And then in Thursday's session, we went up again, and so the red line's starting to go back up. So this is turning more positive. So, and I use these together. The accumulation distribution, this is positive. The Chaikin money flow going back up, that's positive. And the Chaikin oscillator, not really screaming to the upside, but it is going up nonetheless. So our smart money indicators are looking more positive. And the vortex indicator still has a green line above the red line. We're a little bit concerned here that the red line's coming up and the green line is flat. But until they cross, this is still positive. This is a cumulative measure for the S&P, similar to the Bloomberg chart I showed earlier. This is based on price for the S&P 500, where we're still coming down overall here. Excuse me, based on price. And then this is based on volume, where we saw a little bit of an uptick with this chart. Not really seeing any real disconnect right now when we look at the S&P and compare it to the NYSE advanced decline line. And we look at the cumulative advanced decline line for the NYSE based on price coming up here. And then we have another advanced decline, a regular advanced decline line, also still looking pretty good for the time being. And then I look at another NYSE advanced decline line that's calculated in a slightly different way. This is still looking pretty good here. We break it out based on common stock. We tick back up a little bit based on price, and we were pretty much flat based on volume. Advanced decline line still looking pretty good with the NYSE common stock, S&P, mid caps. We're a little concerned about the small caps here. These other indexes are still above the moving average, where the small caps are pretty much on the moving average. This is a little bit of a concern too in the short term. The stocks in the S&P 500 above their 20-period moving averages, it dropped below 50. And that's the line that I use to denote positive from negative. So we're seeing a little bit of weakness there. Declining, but still positive with those stocks in the S&P above their 50-day moving average. And kind of flattening out after declining with those stocks above their 100-day moving average, but still declining with those stocks above their 200-day moving average. All right, so I've been pointing this out for a while here. See this dashed line? That's a previous pivot point that so far has been acting as overhead resistance. We're seeing a very similar reading with the Dow, and I'll point that out when I get to that chart. Until we can really break above this previous pivot point, that should be noted as overhead resistance, but we've just been kind of chopping around. We had slight down days on Monday and Tuesday, a slight up day on Thursday. Wednesday was really the only more significant down day. And we're still below average with volume. Down here, not really showing much of an improvement when we look at the 20, 50, and 200-day. We're flattening out with the 200 here. Now, these are moving averages just on the S&P itself. Like those previous ones, I'm looking at stocks inside of the S&P that make it up. And we're still extreme positive, or excuse me, extreme negative with the Stochk RSI. We're still above the midpoint with the Williams percent R. We're slightly below the midpoint with the CCI 14, and we're coming down and still above the midpoint with the CCI 20. And these are short-term, very touchy indicators, and they usually go extreme positive or negative very quickly. But we're seeing kind of a mix right now with these. This is the short-term stochastic, still above 50 and trying to turn back up, but it's still below its moving average. Declining after being extreme positive in the intermediate term, declining and below its moving average, but still extreme positive in the long term. And we're showing an improvement here with the force index, but it's still negative. Looking at the condition of the 20-period moving average, we're below the lines here, the green line and the blue line, and we want to get back above that to turn this more positive. The longer we stay below it, the more the lines are going to keep going down and actually make the condition more negative. But when we look at the simple and exponential moving averages, we're still holding up. And that was the low that we set here. And these lines are pretty much right on top of each other right now. So that's why the short term is still positive. We're above the 20-period moving averages. Standard deviation, slightly positive here since we're above the midpoint. Then intermediate term, decline but still positive with a balance of power. The condition of the 50-period moving average. Now, we're still positive, but we're dropping below. This is calculated in a different way. This is a double and a triple exponential moving average. So these things are massively different. But they still can help us understand the condition of the trend. The fact that we're closing down below the red line and the blue line is a little bit of a concern. If that continues, this will show some more weakness in the intermediate term trend. If we can get back above this, that would turn the intermediate term trend more positive. Go, no go is looking more neutral now with the lighter shade of blue bars. Still above the midpoint here with the highest high value charts. TTM squeeze, which has been declining all along the way, it's continuing to decline and more negative. We declined, but still above zero with the ease of movement. The Erin finally woke up and said, something happened here. And it had been giving us an extreme positive reading. It came down from that. Well, it dropped. Now it's still positive since we're above zero. But the context here is that we're dropping after getting a very high reading. Ticked up barely, but we're still negative with the S&P McClellan oscillator. So we're going down with the summation index based on price and volume. And to me, these are primary indicators. And that's a pretty big warning flag that we're more negative right now, even though we're above these moving averages. That's why we're getting a mixed picture at this time. Until these turn back up, that's a pretty big warning flag to me. We ticked up here with the NYSE McClellan oscillator, but we're still below zero. So we're declining with the summation index based on price and volume. We're negative with the Swenlin trading oscillator, dropping below zero based on price and volume. And that didn't really change, even with the slight up day. Momentum is starting to shift back more negative. The PMO's crossing below its moving average. We're negative when we break this out based on price and volume. And kind of flattened out here with the PMOs that are rising after they had been declining. The buy signals are going down. And after being extreme positive, the PMOs inside the S&P that have a positive reading, that's starting to wear off too, as we're seeing a little bit of weakness. We're still negative with the S&P when we look at the Elder's Impulse System with the red bar. We're still positive when we look at the parabolic SAR. Slope kind of chopping right along sideways right now. It had been showing some improvement. Now it's coming back down to its moving average, where the MACD intermediate term even short to intermediate term. This is more negative. So then I break it out with all of our different oscillators here. Flat with the short term, looking more negative with the TSI. Those are the short term oscillators. Intermediate term, MACD, PMO, PPO, negative. Starting to roll back over with the tricks. The KST is going sideways and pretty much on top of its moving average after it had been trying to improve. And after crossing over positive, the Copic curve is now back to crossing over negative. Seeing these mixed pictures we're seeing here. We're no longer extreme positive with the Sean trend meter. Money flow, pretty much going sideways, but still above 50. Ultimate oscillator went up and still above 50. So these are secondary indicators are still positive. And we almost got down to the moving average here, but on balance volume is still above an advancing moving average. And we're looking good here with the RSI. We're still above 50 in the 14 period. We bounced off the 50 level here with the short-term RSI 9. And here is another look at how we came right down to the 20 period moving average, and then we're able to bounce up off of that. So the short-term trend is still intact for the time being. This is a little bit of a concern, though. After getting a very high reading with the bullish percent index, even though we had a slight update, the BPI is continuing to go down. And if we drop below 70, that would turn it even more negative. It's not full-blown negative until we drop below 50, if that even happens. And after getting a very high reading here with the NYSE bullish percent index, the context of this is that it's also going down, where we're flat now after declining with the NASDAQ 100 bullish percent index. And this is an indicator based on the open, high, low, close on 20 periods. This is more short term, where we came down and we're showing how these areas are still providing support. If we can stay above this rainbow and have the rainbow continue to go up, that would be positive. If we break down below it, that's going to be more negative in the short term. So we're seeing a mixed picture here. The Heiken Ashi is now looking more negative. The Kegi chart is negative since it's red, but now it's pointing up. So there's a slight positive bias to it. Or the Renko chart, it's like, what happened? Not much. Okay, I'm still going to stay positive. And the 3-line break is still looking positive. So we have negative, positive, and kind of getting a mixed picture here with them when we look at different ways of measuring the trend. Long term, still above the red line here with our 150 and 200-day moving averages, but they have been declining lately. So we are negative with the mid caps in the short term, as well as the small caps in the short term. All the other indexes are positive, and bonds are still negative based on price in the short and intermediate term, where commodities and the dollar are still negative in the long term. And saw kind of a mix across the board here with discretionary doing well. And that was pretty much Tesla with Amazon helping out and communication and tech. These are the three growth areas. These are what we want to see doing really well if the market is going to go up. And they had a pretty good day on Thursday, where we saw materials, which is more generated by the what's going on in the economy. That ended up being probably the weakest area of anything right now. So we saw some nice little Christmas colors here, green or blue right to start off with, and then as we were fighting for things later, then it turned red, where the S&P opened up above 5,800, but then it went below, but then by the time we got done, it was back above. It doesn't seem to come up here. Materials having a BPI cross below 70 after looking solid. Industrials, another economically sensitive area. It was giving a very high reading above 80. Now it's crossing below that 80 level. And then we had the NASDAQ going above 18.3 and 18.4. I showed this because somebody finally decided to update this chart. In the short term with the PMO, we are now negative, which is the chart that I just showed a minute ago with the PMO dropping below its moving average. But this is put out by Decision Point, but it's maintained at stockcharts.com. With their trend models, they're still looking positive across the board, and we're still positive in intermediate and long term. Not really seeing much of a disconnect here between the S&P and the equal weighted version of the S&P right now. Here's the Dow, and this is that pivot point level that I was pointing out for the S&P. We're also seeing one here for the Dow. The Dow just could not get above this level after setting an all-time high and has been seeing some recent weakness. And we're negative with the Elder's Impulse system for the diamonds. The NASDAQ was up about 0.75%, but just pretty much chopping sideways right now. NASDAQ 100 also kind of chopping sideways, but had a pretty good day. on Thursday. We've gone from negative to neutral with the QQQs when looking at the Elder's Impulse system, but the momentum for the NASDAQ 100 is still negative. We're dropping below the moving average as the indicator is going down. And I showed this yesterday. This is a chart that I kind of show and then don't show. We had fallen below the short-term 20-period moving average with the QQQs, which is the NASDAQ 100. Well, we closed below that, but then we were able to close back above it in Thursday's session. So that's slightly more positive. Small caps, after breaking out, have been breaking down, but they're still above their 50-day moving average. Look at the Russell 2000 small caps, still below 50, even though it turned up a little bit with the RSI, still above its 50-day moving average here. But the momentum, as measured by the MACD, is negative. And we continue to be negative with the Elder's Impulse system for the small caps. Mid caps also coming off of really nice readings here, but under some weakness lately. Continue to be negative with the mid caps when looking at the Elder's Impulse system. The Wilshire up about the same as the S&P, up about 0.25% here, coming off of recent all-time highs last week. Same thing here with the total U.S. stock ETF, up 0.28%, highs last week, pulling back, but still holding up above its 50-day moving average. The staples to tech ratio really chopping around right now. We want this to go down if we're more positive on tech. If this is going up, that means we're more positive on staples, which is more defensive. The financial sector coming off of a recent all-time high, up slightly, still above its 50-day moving average. The FANG index up 0.86%, above its 50-day moving average. Apple was down just slightly, but still above its 50-day moving average. Amazon up 0.9%. That helped discretionary a bit. Microsoft, it's just barely. It was up 0.03%, but it's bouncing off of its 200-day moving average and avoiding a death cross, at least for right now. Google was down. It's kind of right near its 50-day moving average. And Meta was up almost 0.75% above its 50-day moving average. Tesla, that's the big one. It jumped. We had been hanging out below its 50-day moving average, and it jumped back well above its 50-day moving average now, up almost 22 stinking percent in one session. Wow. And Nvidia was up 0.61%, still looking pretty solid here. Netflix, after a week ago reporting earnings, seeing a little bit of profit taking, we were back up 0.7%. Seeing a little bit of an improvement, but we're pretty much neutral now when we look at the correlation between U.S. stocks and world stocks, both in the short term and in the long term. Oil just kind of hanging out around the 70 level for the time being. We're watching that for geopolitical reasons. The dollar was able to bust back above its 200-day moving average, saw a little bit of weakness, but when I took this chart, we're seeing a little bit of a bounce in the dollar index. And after really going up, the 10-year yield, we finally dropped back down a little bit, but we're still above the 200-day moving average. And we're still seeing overall weakness here when we look at the 10-year based on price. And then seeing our growth to value ratios coming right back up to the moving average with the Qs to S&P. Discretionary really spiked up. That was mainly Tesla, which was helping that. Seeing a little bit of an improvement when we compare large cap growth to large cap value. So we're pretty much on the moving average here with the large caps, slightly above with the mid caps, and slightly below with the small caps. Nice mixed picture there. Overall, we've been seeing the S&P to utilities ratio going down. We want this to go up if we're more positive on the S&P. We want this to go down if we're more positive on the S&P, though. Kind of the opposite of the previous chart. This is the staples to S&P ratio, been chopping around over the last few days. But for the most part, this has been declining, and that is more positive. So what's our outlook for Friday? We're still positive with the technicals, and I mainly measure that by where are we in relation to the 20, 50, and 200-day moving averages. But we have been pulling back after setting that all-time high last Friday. We do have a confirmed Hindenburg almond, which I'm not showing that chart for right now because there's been no updates other than time going by. And we do see weakness developing. Now, a good solid up day could take care of that, but a solid down day could add to this and actually turn things more negative. So when we look at the short term, the earnings reports this week, I'm not sure if Boeing's earnings actually came out. It was the news about the strike that was driving the price down. Tesla came out with their earnings, and we're going to get UPS. And there's a whole slew of earnings that are coming out this week. And we're going to get durable goods and consumer sentiment. Those can be rather influential. And then all the geopolitical things going on in case they have an impact on the market. And we'll be finishing out the economic calendar for this particular week. And here's the durable goods and what they saw last time and what the forecast is. This calendar sees durable goods as the most important. I think consumer sentiment is also pretty influential. Seasonality, we're neutral to negative with the Dow and S&P, or we're neutral to positive with the Nasdaq. So not much of a real change there. We are getting ready to finish out the week after options expiration, where we tend to be down more than we are up during this week. And we've kind of lived up to that, at least to this point. And we still have some negative seasonality here when you look at the green dashed line, which is the S&P during an election year. This is the weakness that we've been seeing. We're actually sticking to seasonality right now, where we pretty much ignored it for the whole month of September. And Friday is one of the more positive days based on what happened in 2023. It's the second most positive day of the week based on what's been happening in 2024. And this is the blackout chart here. We're starting to see that coming down a little bit, where a lot of these companies could not report. These are S&P 500 companies because they're coming out with their earnings report, so they can't come out and buy stock or say, hey, we're going to buy back a whole bunch of stuff. So they have a blackout period during this time. It's still pretty high, but it's coming down. So we're kind of getting beyond where that has the most impact. And isn't it strange that we've been having a little bit of difficulty in the markets lately? So the warning signs are the negative things that we're watching. We do have a confirmed Hindenburg-Ullman, which may come into play at some point. We're watching the more defensive sectors like staples, utilities, and healthcare, and energy more for geopolitical reasons. The 10-day equity put call ratio is going up slightly. It's been just chopping around all over. The Swenlin trading oscillator is now turning negative. We dropped below zero based on price and volume. And the S&P and NYC McClellan oscillators, as well as the summation indexes, are negative. Our oscillators, including the Copic curve, are turning back negative. And we're keeping an eye on growth to value. Showed some improvement there with the S&P growth to value ratio. Discretionary had a good day, but can it continue? Are we going to see more buying going into Tesla, especially when you compare it to the staples? And we take a ratio of that. But the momentum for the NASDAQ 100 is negative. We're below the moving average with a PPO declining. Positive sign, we're looking better here with our three smart money indicators: accumulation, distribution, the Chaikin money flow, and the Chaikin oscillator. The 5-day equity put call ratio is going down, but now we're getting an extreme reading with that. And that sometimes can be a bit concerning, kind of like sentiment when it gets to be too positive. The advanced decline lines looking a little weaker with the small caps, but all the rest of the indexes are still looking good. And with the bullish percent index, we're coming down after getting an extreme reading with the S&P. We're also coming down with the NYC bullish percent index after it had a really high reading, and the NASDAQ 100 was pretty much flat. So we want to look at the context of this, that they're positive, but they are coming down. Parabolic SAR is still positive, as is the vortex, but it's declining. The money flow and the ease of movement are still positive, and the ultimate oscillator is positive, and the financial sector is still positive. So our conclusion, we are positive, but we've been pulling back, and we're still saying, is weakness developing? Are we going to bounce off this 20-day moving average and see that weakness go away and show more strength? That's why I have a question mark right here. In the short term, so far, the 20-period moving averages have been holding, and that's why we remain positive. In the intermediate term, this is where we're seeing some weakness, especially with the summation index. That's a little bit of a concern. And then secondary to that, in my opinion, is the Swenlin trading oscillator turning negative. And then we see other things like the bullish percent index starting to come down from a high reading. But we are still positive in the long term. Thank you. I hope you have a really good day, and I will talk to you in the next video.